Wall Street, meanwhile, watching lots of things this week. The Federal Reserve, global central banks, battles on Capitol Hill, and yes, even the president's Twitter feed, which some say may be getting in the way of the economic agenda. Joining me right now is Strategas Research Partners Chief Investment Strategist, Jason Trennert is with us. Jason, great to see you.
Great to see you.
Especially since you have been a long-time participant in Wall Street Week.
Right.
From the days of Louis Rukeyser.
That's right.
So we're happy you're here. Tell me what the markets are focused on right now. Obviously, we've got a bill sitting in the Senate. Now here we are on July 4th weekend. They didn't do it. Do you have confidence that they're going to get this done?
Well, the good news, I would think, is that the market is probably telling you that, at the very least, Washington's not getting in the way. The market seems to be discounting better economic growth into 2018. Our opinion as a firm is that our variant perception and non-consensus view is that the administration is going to get more of its economic agenda through, particularly as it relates to deregulation of financials and energy. I do think there's also clearly going to be kind of a food fight when it comes to the tax bill that'll come later on this year. But even there, even though tax reform may be difficult to get through, tax cuts, in our opinion, are very, very likely before 2018.
So this is like a non-consensus thing. I mean, your firm thinks things will get done.
Absolutely. I think, first of all, as far as deregulation is concerned, personnel is policy, which is to say that the laws don't have to be changed. It's the people that are interpreting the laws as far as the regulatory apparatus is concerned. Those make a big difference. You don't just have to change laws. You just have to have people that think about them a bit differently. And I think, again, for financials and energy, that's absolutely the case. The other thing we believe is just that there's no atheists in Foxholes. There's not a lot of profiles encouraged among Congress. Republicans in Congress are going to have to deal. They're going to have to cut. If they can't get tax reform, they're going to have to go for a tax cut before the 2018 midterms. And I think there's broad bipartisan support for some parts of a tax cut, particularly a tax cut on repatriated profits, lower tax rates on corporations. We think those things will get done by the first quarter of 2018.
So you think we're going to get a health care bill? They're going to cross the finish line, and then in terms of tax reform, it may very well just be tax cuts. Yeah,
I think that's at this point, I think it's most likely. It's simply because you're running out of time, and again, the attitude in Washington, or the zeitgeist in Washington, does not allow for a big bill that requires taking people from across party lines to get things done. Unfortunately, I wish it were different, but it just doesn't appear to be the case. One other thing I would just mention where I do think there's some risk, which would be in FANG and some of the tech stocks. And I think this is just something where energy and financials were seen as, I don't want to say evil, but certainly a part of the problem in the last 8 years, and tech was largely politically insulated. I think lately, in this administration, those roles are being reversed. Tech and energy, financials and energy are seen as part of the growth strategy, and now there are real questions with Amazon buying Whole Foods, with Facebook, with Google, and the EU antitrust issue. There are real concerns about the concentration of power in some of these technology stocks.
That's a really good point.
For investors, that's just one kind of change I would keep in mind, one of the potential risks for these very high-priced stocks.
That's a great point, and that's what we're seeing, investors giving a second look at financials, energy. That's probably the sweet spot of the president's agenda.
Absolutely.
Because of energy and the rollback of regs in financials. So FANG being Facebook and Amazon and Netflix and Google, they had a rough week.
Yes.
So this is beginning to happen. So tell me how you want to allocate capital right now. Obviously, index funds, ETFs, passive investing has been working. Does it still work? And how do you invest today? Do you like small caps? Do you like any area of the market better than others? Yeah,
so to answer your first question, I think active management is going to make a big comeback, and I'm convinced that part of the reason why active management has done so poorly is because central banks have been purposely suppressing interest rates, which has short-circuited the creative destruction process of capitalism. Meaning, you've kept a lot of very weak players in retail and energy and other sectors in business that would normally go out of business. And that sounds nice, but the problem is that it's very difficult to allocate capital properly that way, and it's very difficult for an active manager. As rates normalize, I think active management is going to do quite a bit better. And you'll see more volatility in the economy. You'll see more volatility with some of these sectors. As far as small caps, we have a bias towards small and mid-cap stocks over large cap stocks now, and that's largely because they'll be the biggest beneficiaries from lower regulations and lower corporate taxes. The large government systems tend to favor very large companies because they have the lobbyists, the accountants,
right, sure,
the lawyers to maneuver the levers of government in their favor. That's why there's 3.5 million words in the tax code. So to the extent to which you're starting to relieve some of those pressures on taxes and regulation, in our opinion, small and mid-sized companies do a lot better.
We're going to talk to Alan Greenspan in a moment, but when I had him on the morning show this past week, I asked him, are you worried about the Federal Reserve winding down the $4.5 trillion balance sheet? He said, Maria, I can't answer the question.
Yeah.
So I took that as, yeah, I'm worried. Do you worry about that? And what about this, the transition at the Fed? Janet Yellen's going to be stepping down.
Yeah, so the pace at which the Fed is talking about winding down the balance sheet makes me less worried than I ordinarily would be. I would be worried about it, but the pace that they've laid out so far is so, the fellow in our office described it as glacial, that I'm not sure it's going to make that.
Won't have a big impact.
It won't have a big impact. I might take a different point of view, too. At this point, the irony could be that Janet Yellen could be the most likely successor to Janet Yellen.
Okay, so you don't think she steps in?
I don't. You know, I think
her term is up. She doesn't have to step in.
She doesn't have to step down, and the president, I think, has indicated that there's kind of an uneasy peace between the two. They're becoming kind of secret. You know, I don't know if they're BFFs or whatever, but I think a truce has been declared, and they're kind of on the same page now. So I think that would be good for market continuity. I think you do have to have someone that obviously she's very well qualified. She's quite good. She's a very dovish person, and I think most presidents like dovish Federal Reserve chairman.
Yeah, they sure do. Jason, great insights from you as always.
Thank you.
Thank you so
for having
much.
me.
Jason Trennert.